Sam and Jennifer are both self-employed. They each run great businesses and they have the same financials, but they have different borrowing capacities. How is this possible? G'day, I'm Aaron Christie David, mortgage broker and founder of Atelier Wealth. I specialize in helping Australian families start out and scale up their investment property portfolios. Being self-employed can often feel like you're getting the raw end of the deal when it comes to borrowing capacity. However, you can control your income and how much you and your accountant choose to determine as your income. So why is it so hard for banks to give you a loan? In our other video, we spoke about what affects a salaried earner's borrowing capacity, but there are a whole lot of different elements that affect a self-employed earner's borrowing capacity. So let's talk about why this varies from bank to bank. But before we get into it, I just want to preface that this video is general in nature and not intended to give advice. I always suggest chatting to a qualified mortgage broker who can give you the best guidance for your situation. So, borrowing capacity varies from bank to bank because each lender has its own conflicting and confusing ways of calculating it. That's why it's so important for self-employed individuals to chat with a mortgage broker because they can iron out which bank and loan product is better suited to your financial circumstances. First off, some banks will look at your most recent financials, while other lenders will average your last 2 years' financials. So if your business performed better in the most recent financial year, then you'll want to look at a bank that will consider your last year's performance to give you a better borrowing capacity. Secondly, you can consider alternative ways to verify your income, such as business activity statements, business bank statements, or an accountant's letter. This becomes important if your goal has been to reduce your tax bill, but you still want to be able to borrow. Yes, you might have to pay a slightly higher interest rate, but if your accountant has you paying less tax, then let's consider that the lesser of two evils, right? Lastly, some lenders will consider add backs. This means that you'll be able to add back your depreciation, interest expenses, donations, and other line items in your financials. Not all banks have the same policies. So if your business has purchased new equipment or vehicles and there is enough depreciation to add back in, this can also bump up your borrowing capacity. As a bonus point, some banks will look at your income and base your borrowing capacity on how much you are paying yourself on a regular basis. It's also important to remember that different lenders will have different assessment rates, benchmarks for living expenses, and considerations for your other debts such as credit cards and HECS. A mortgage broker will factor all of this into finding a home loan or investment loan product and lender that aligns with your current financial situation and future financial goals. But you'll need to establish whether you want to borrow more or have a lower interest rate, because in my experience, you can't have your cake and eat it too. That's it from me. If you have any more questions around borrowing capacity, if you're self-employed, drop them in the comment section below, or check out the link to our borrowing capacity FAQs in the description box. I hope this video has been helpful to you in understanding the ways that banks calculate your borrowing capacity. If it has, make sure to give it a thumbs up and hit the subscribe button for more property investing tips. We'll see you next time.